Good morning. We've just celebrated the first anniversary of the Brexit vote, if I may say so. And that referendum delivered an outcome that will change the face of Europe for the years to come. Because after 43 years of patiently built relations, our paths are set to diverge as a result of a democratic process which we respect, but we regret. I would say from the outset that our main wish in the Commission is for the UK's withdrawal to be orderly and based on a negotiated and fair deal. And this is what I have difficulty to say my colleague, Michel Barnier, because it's not really my colleague, but Michel Barnier is doing as chief negotiator for the EU. As you know, in March, the government of the United Kingdom activated Article 50, and 2 weeks ago, negotiations started. So that means that the UK and the EU now have less than 2 years to find an agreement on the terms of the UK's withdrawal. And that agreement should take into account the framework of the UK's future relationship with the EU. These are the terms of Article 50. Should there be no deal, the UK's membership will automatically end without any specific regime on 29 March 2019, unless the European Council and the UK jointly agree to an extension. In this process, the EU 27 have decided to manage the withdrawal in a way that tries to reduce the uncertainty and prioritize fairness. Withdrawal negotiations have just started, as I just said. This is a very good development in terms of improving certainty and starting to build confidence in the process that lies ahead. Talks will continue on a monthly basis, and the outcomes will be publicly communicated between rounds. On the EU side, we have published the overall general negotiating directives, and before each round, we are publishing negotiation positions and agendas. So I would say it's a very, very transparent, unprecedentedly transparent process. Those of you that have seen the EU negotiating documents on the internet have maybe noticed that financial services are not being addressed at this stage. And this is because the withdrawal negotiations are focusing on what is necessary for the UKs to withdraw, and these are citizens' rights, the settling of UK outstanding financial commitments to the EU budget, and a number of other separation issues, in particular borders. The principles of the future relationships are therefore not and could not be discussed now. It is our hope that progress will be rapidly made after each round of negotiations. And once the European Council has decided that sufficient progress has been made on the priority issue for withdrawal, it is agreed that talks may start to include discussions on the principles of a future relationship. So what is in for financial services? Well, I would say that as a consequence of what I just explained, beyond the clear fact that the UK will cease to be an EU member, the precise end state is not yet known. In other words, it is at this stage very unclear what the new relationship is going to look like as far as financial services are concerned. An agreed framework or not, of which nature, all of this is unknown. So what should financial firms do to prepare? Well, our advice is that adaptation should start now. And adaptation, of course, doesn't mean the same depending in which sector of financial services you're working. And preparations should reflect probably the worst case scenario, so the scenario of a withdrawal without a deal, which is again not what we want to achieve, but is not a zero probability outcome. And this way, if there is a deal, as we hope, firms will be prepared in any case to build their adaptation strategy, whatever the new framework will be. So, ladies and gentlemen, while we are very committed to these negotiations, it is extremely important that the Commission remains focused on what the EU should look like at 27 and how best to equip the financial services market in the EU 27 for that outcome. So I would like to dedicate my remaining speaking time to explain our ongoing regulatory and policy work in that respect. In line with the overarching priorities of the Juncker Commission, it is still geared toward increasing jobs and growth across Europe. We have sharpened the overall policy direction to take into account the fact that in a not too distant future, the European economy will have a reconfigured relationship with London. Currently, the world's largest international finance center is within the European Union. In 2 years' time, it will be outside, and it is unclear what the relationship is going to be. So, as a regulator, the European Commission is interested in deepening the opportunities for financing the European economy while preserving financial stability in that context. The EU will take every measure to be, and I will come to what we call CMU 2.0, so the midterm review of the Capital Market Union in a minute. We will take all measures to be an even more attractive place to do business for financial services. And at the same time, we want to make sure that risks that are associated with the financial system are properly managed within the Union. It is our job to create the right incentives and to tailor more closely the overall regulatory and supervisory framework to make sure that key systemic risks of the Union are appropriately overseen by the EU. And this is in this context that I would briefly like to refer to our recent proposal to amend the EMIR regulation. Since the adoption of EMIR, mandatory clearing for certain asset classes, as well as an increased voluntary use of central clearing, have led to a rapid growth of the volume of CCP activity. The benefits of central clearing for market participants have caused a rise in the quantity of voluntary central clearing, and as a result, in the quantity of the associated concentration of credit risk in these infrastructures. In light of this trend, the original EMIR supervisory arrangements for both EU and third country CCPs needed to be made more effective. Our proposal reflects the Commission's commitment to the international standards set by the Committee on Payment and Market Infrastructures, better known as CPMI, and the International Organization of Securities Commissions, IOSCO, as well as the Financial Stability Board, the FSB. Within this international framework, the proposal provides for a new enhanced toolbox to supervise and manage risks more effectively. It is in line with legislation in other parts of the world and builds in particular in the experience with supervisory arrangements in the United States of America. The framework for the recognition of third country CCPs and their supervision will continue to be based on equivalence. Of course, with significant enhancements. ESMA, in its new CCP executive session, will be responsible for monitoring and supervising all third country CCPs. Non-systematically important CCPs, so-called Tier 1 CCPs, will continue to be able to operate under the existing EMIR equivalence framework. However, ESMA will have more effective powers to require and access information. Conversely, systematically important CCPs, so-called Tier 2 CCPs, will be subject to stricter requirements. And when these requirements are deemed insufficient to mitigate the potential risks for the most substantially systemically important CCPs, the Commission may decide that this CCP will only be able to provide services in the Union if it is authorized under EMIR. Additional supervisory requirements may also be requested by the relevant central banks of issue, and you might have noticed that the ECB made a proposal to modify Article 22 of its statutes to that effect. In order to ensure proportionality in these requirements, a system similar to that in the US of comparable compliance is introduced. This will enable CCPs to ask ESMA to compare EMIR's requirements with those of the third country, and if these third country requirements are comparable to EMIR, ESMA will be able to take compliance with these requirements into account, what the US call substituted compliance. At the same time, we are enhancing the supervision of CCPs that are established in the EU. For the CCPs established in the EU, the responsibility for CCP supervision will stay at the national level, but however, the role and responsibilities of ESMA will be reinforced. In our proposal, this reflects the relevance of CCPs for the entire EU system through the new CCP executive session. Additionally, there is a twofold reinforcement of the role of the central bank of issue for CCPs, most active in instruments denominated in the currency of issue, so the euro, but not only the euro, maybe the Swedish krona as well, for example. First, these central banks will become members of the CCP executive session. Second, they will have certain prerogatives with regard to supervisory decisions relating to these CCPs. The new EMIR approach thus helps to create a level playing field for clearing activities within the EU. We should also expect it to serve as a blueprint for further work to improve existing EU equivalence regimes in other fields. There is also scope for clarifying ESA roles in the monitoring and enforcement of Commission equivalence decisions. This work is currently ongoing in the context of the ESA review. Ladies and gentlemen, last month, the Commission adopted a midterm review of the Capital Market Union. This initiative was launched in 2015 with the specific objective to create stronger capital markets to provide alternative or innovative sources of corporate financing and help increase long-term investment options, especially for projects not easily captured by public funds. The ultimate beneficiaries of the CMU are EU businesses and households, and in just 20 months, we have delivered around 2/3 of the initial 33 commitments undertaken by the Commission in September 2015 in the original CMU action plan. In the EU, most corporate finance comes from banks, and only a small part from capital markets without bank intermediation. It is reasonable to expect that ratio to remain significantly skewed in favor of banks once the UK leaves the EU. And it is therefore necessary to recalibrate the CMU to ensure that EU businesses and investors will have access to strong, dynamic, and more integrated capital markets, while the risks to financial stability will be properly managed. In other words, we need to move from a concept of capital market union with the city at its center to a concept of capital market union in the framework of an unknown new agreement, a new settlement with the UK, and in other words, unknown new relationship with the city. This year, I just alluded to it, we will come forward with a review of the European supervisory agencies to further integrate EU financial supervision. Steps are underway to increase the ability of the ESAs to preserve EU orderly markets and financial stability. We expect the review to contain proposals to amend the ESA funding regulation and mirror those changes where relevant in other sectorial legislation. The reflection paper on the deepening of the EMU that was published in May stressed that a more integrated supervisory framework ensuring common implementation of the rules for the financial sector and more centralized supervision enforcement will be key to building this new CMU. In other words, to the extent possible, we will need that what we call the single rule book, so the single set of regulations that apply throughout the EU 27 is more and more a EU effective enforcement regime. In other words, that the single rule book doesn't mean something that is not so single depending on the jurisdictions within the EU 27. Separately, we are also working on the review of the prudential treatment of investment firms, and we have just launched the impact assessment with a view to setting out an adequate framework for the amicable resolution of investment disputes. Next year, we will carefully consider the extent to which CMU-relevant initiatives could be deepened in areas such as non-performing loans and fintech. We also explore possibilities for more proportionate regulatory environments for SMEs and for the cross-border distribution and supervision of UCITS and AIFs. And I also would like to mention something that's very dear to my heart, and that is the follow-up to the recommendations of the high-level group on sustainable finance, as a result of which a number of targeted measures are already being prepared in relation to disclosure and the wider application of sustainability concerns across a range of methodologies in financial services and supervisory processes. So by the end of this year, a CMU working group will also issue a report on challenges and solutions for the further development of capital markets in jurisdiction in Central, Eastern, and Southeastern Europe. The Commission is also making technical support available to the national authorities of the member states concerned to help broaden the geographical reach of capital markets through proximity and local solutions for SME funding. I've been visiting a number of these jurisdictions, and its market participants there are having a hard time building ecosystems in order to develop local capital markets and connect them to the bigger centers within the EU. We are having a joint work with the colleagues in the support service, the SRSS, led by my colleague Martin Verwey, in order to provide these jurisdictions with support and expertise. The CMU is a multidisciplinary, multifaceted, complex file. And I'm not doing justice in the time available to a number of other related work that is on track. I would like to take as an example the work that we have jointly with all the member states in trying to identify and dismantle national barriers to investment within the EU. That's a very long, complicated, tedious process, but it's very necessary. We have issued a first report a few months ago. We continue this work because I strongly believe that we will not achieve a genuine capital market union if we don't manage to make member states realize that, first of all, these barriers exist. Most of the time they are here for very long. They have forgotten them. They don't even know why they put them in place in the first place. Secondly, that this is their best interest to dismantle them. That is a lot more effective than building infringement procedures, going to court, etc., which takes a very long time and is not a very effective way to deal with this. So, the capital markets post-Brexit that we are trying to, not to build, because it's not the Commission that will build the capital market post-Brexit. the capital market post-Brexit will be built by market participants. But for market participants to be able to build them, we need to understand why a number of intermediation that could have happened, maybe should have happened, have not happened in the past, and modify to the extent necessary the legislation, either of the member states or the EU legislation, in order to create the right incentives for the market to occupy that space in a more effective way that they've been doing so far. And another way of describing capital market union is that capital market union is about a market failure. It's about a 500 million people EU in which citizens save more than they have ever saved in history, because we're aging, because we are fearful of the crisis. So there is a lot of savings available, but these savings have a huge appetite for short term. On the other hand, we have a huge number of investment needs, but these investment needs sometimes have difficulties translating into actual investment projects. And even when they do, we cannot connect these savings to these projects effectively, while savers would need to have long-term use for their savings in order to provide long-term yields, in order to save for their old age. And we certainly do need more long-term finance in order to be able to finance the infrastructures in particular that we need, but not only the infrastructures, also the industrial projects. I mean, there is increasingly less investment in Europe into industry, because industry is very long-term returns and it's low returns, but it's usually quite safe returns. So we need to find a way to re-incentivize this type of things. And this is what capital market union is about. It's even more crucial after Brexit than it was before. And this is what we're busy doing at the moment. Thank you very much.
Many thanks, Olivier. There are urgent questions from the floor. If not, I will use my privilege to share with Olivier the following thing. At the end of the first panel this morning, which was a capital market and post-trade services panel, and we're having the asset management panel now and the insurance panel later. But at the end of the first panel, I asked each of the speakers to say in one sentence what their recommendation to Brexit negotiators would be. You know, for an ideal world, i.e. the European economy keeping on being financed, you know, for the better of the European Union and the UK, because we're on the same boat at the end of the day. And the near unanimous answer was avoid cliff edge effect, manage a transition period, put in place grandfathering clauses in order to make sure that we have a continuity of what exists today and that there's no abrupt disruption. So there was, you know, I hope I'm reflecting what came up. There was the unanimous answer from the panelists. What does that inspire you? Something? I mean, how do you see that? Do you take that as an important recommendation? Do you have a view on this?
I can only repeat what Mr. Barnier has repeatedly said. I mean, you're absolutely right, and the best way to have a smooth transition, which I think is what everybody wants, is to have an agreement that allows for that smooth transition. And I understand this is the stated objective of Michel Barnier. Whether the political conditions for this agreement to happen will be met is something I'm completely incompetent to tell you. The only thing I can say is that there is a non-zero probability that they are not in the end of the day. So therefore, the way I see my job, as I think the way my colleagues in the UK see their job, is to prepare the unilateral framework through which you will best manage these transition issues unilaterally in order to minimize the consequences as far as you are concerned, and they will do the same. Of course, if we don't have to use these unilateral frameworks because we have an agreed framework, it's probably better. But as we don't know, I think we have a duty to prepare for that unilateral framework, and this is the message that I was trying to convey, and this is what we are doing, and all the measures that I have alluded to are about this, because we are not at the time of the negotiation now. We are at the time of negotiating the withdrawal. We're not at the time of negotiating whatever the new relationship will be. So whether there will in any case be a new relationship. Will it be unilateral? Will it be agreed? And if it is agreed, what it will look like, nobody knows. So I think firms and regulators have a duty to prepare themselves for the worst case scenario, and hope that the worst case scenario, of course, will not happen, but be ready for that.
Thank you very much. And good news is that the recommendation coming from business, at least conceptually, I said conceptually, meet, the reasoning of the negotiators. But that's one thing, and that proves, if needed be, that the situation is more complex than one camp against the other. It's much more complex because there are many different interests in. On each side, and that's exactly what you're saying.
But more importantly, Thierry, I think it's important to understand that there are legal requirements, and the legal requirement is that what Mr. Barnier has a mandate for, and he couldn't have a mandate for anything else, is to negotiate the terms of an orderly withdrawal. So that needs to be done, and the quicker these terms can be agreed, the better, because then we can move forward. But I'm not engaging into any speculation at this stage, because before this is done, or before this is, as the European Council said, sufficiently advanced, we will not start discussing the rest. And I hope it will be sufficiently advanced, sufficiently soon, that we have time to discuss the rest in a time that is still materially relevant, but I simply don't know.